Hello everyone, my name is Murugan. I'm a SEBI registered research analyst and I welcome you to this playlist where we perform a lot of data analysis specific to stock market. And in this video, I'll be talking about option chain analysis by taking a specific factor called at the money premium. And we will be using some tool to crunch hundreds of option chain data in a fraction of a second and which helps us to form some option strategies. I'll quickly present you the tool now and then I'll explain why at the money premium analysis plays a critical role. Let's quickly get started. Let me begin by giving you a preview about this at the money premium analysis tool, which you can find it in EQSIS website. This is quite useful to decide either to go for long straddle or short straddle because it gives you a volatility screener in a very handy. So if you look at this particular tool, this compresses hundreds of option chain and it helps us to filter based on high straddle range or low straddle range, and you can double check with the volatility as well. So let's say if you want to filter the underlyings with high straddle range, it means it has a high premium. And if you look at the low volatile scenario, in a couple of clicks, you can short hundreds of option chain. That's the magic that this particular tool can do. But you need to know the concept behind this to use this tool effectively. So that's why I'm going to spend some time in explaining you the concept. Then I'll get back to this tool in making you understand how to use this tool effectively when it comes to your day-to-day trading life. So to explain this tool, let me take this whiteboard here. My very first question is, why at the money premium analysis? Okay, now that's the question here. Why at the money premium analysis? That's my question. See, what do we mean by at the money premium? So we have call options, am I right? And we have a put options. And we have various strike prices, but we are looking at the strike price where we have the underlying is currently traded. So when you add call option premium along with put option premium, and we term that as at the money premiums. Okay, now at the money premium is sum of call premium and put premium belongs to the at the money strike price. So that mostly have a high high time value, am I right? So that gives you a quite a good range for you, and most likely that the market travels within this particular range. That gets about 68% because that talks about a one standard deviation from this particular area. So let me make it simple. If you see a 30 rupees a call option premium and 28 rupees as put option premium, and you end up getting something like 58 rupees, and 58 rupees from this, let's say a 700. So 58 rupees on upside and 58 rupees on downside gives you a couple of break even. That gives you a kind of range, am I right? And if you long a straddle here, you hope the market to go beyond this area, or if you short this straddle here, you expect the market to remain within this particular area. So that's the a break even for straddles, long and short. But the question here is, this 58 rupees premium, okay, this 58 rupees premium is gonna decide whether you should go for long straddle or short straddle. Many people mistakenly, keep buying straddles thinking that I can make money in both the sides. That's a very wrong ideology. Believe me that most of the time market settles within this particular range. So you end up getting losses most of the time. Am I right? And other way around, many people believe that short straddle is the only way of making money, and many option sellers lives only by selling straddles, and they actually takes that whole premium of 58 rupees and they hope the market to settle within this range. Yes, it is true that the market settles mostly within that particular range, but the time when market goes out, if you are poor in risk management, you end up burning your hands. So by default, there is nothing like long straddle or short straddle is good to make money. There is something else decides it. That is the factor called at the money premium, and you need to value whether that particular premium is above its equilibrium or is it below the equilibrium. Let me explain what do I mean by this. Let's say you take at the money strike price, which is 700, and you see the premium is 58 rupees. But and you have time to expiration. The time to expiration is about 10 days, let's say. So within this 10 days, if market gets a chance of going beyond this upside 58 or downside 58, am I right? It is better you actually go and buy this particular at the money straddle in order to make money, because either way it goes up or down, you make money. In that case, you expect high volatile scenario to happen. Am I right? But the question here is this 58 is that correct premium, or is 50 is a good premium to buy, or it in general it's supposed to be the premium of 70, now it is only 80. So the question is about, is this 58 is overvalued or undervalued? That can be sensed by looking at historical premiums. Let me explain it again. Pay attention here. See, what happens is, I told you now I have 58 rupees premium for another 10 days for the expiry. But this is, let's say, a June month. But likewise, we had a May month. Likewise, we had a April and March. Am I right? And Feb. So now we need to know May month 10 days before expiry, what was the premium? And uh, April 10 days before expiry, what was the premium? And March 10 days before, what was the premium? And Feb 10 days before expiry, what was the premium? Because by taking this particular average, you get an idea whether this particular 58 rupees is justifiable or not. By any chance, this average gives you, let's say 40, now the premium is 50. It is natural. Sometimes the premium tends to be quite higher than this because market expected volatility. I mean, sometimes we use the term implied volatility is quite high because market is discounting some unexpected scenario on which the premium tends to be high. But we need to know how is the premium in the recent times as well. Am I right? Because within June, today maybe let's say 15th, and I want to know what is the premium on 14th, what is the premium on 13th, and what is the premium on 12th. Do you see there is a dip in volatility or increases in volatility? And I want to benchmark this. What will be the benchmark premium for 10 days expiry ahead of this? This particular data analysis is what specifically done by this particular tool, is what we are actually presenting it. I hope you got some clarity about what I'm trying to convey here. Okay, let me present you with actual data so that it makes it much easier. But don't limit yourself just to see this particular video alone, because anything that you learn, am I right? That's gently that we say in our training sessions as well, that instead of learning it alone, you better see how we are doing it and try perform as well in a way that if you start repeating it, it becomes natural. So I'll be using this tool to give you an actual scenarios here. So first, let me show you how to find this particular tool. Go to Google if you are familiar with this and search EQSIS at the money premium analysis tool. Okay, go to this way. And if you get into this, visit our EQSIS website here, a very first link that you get to know. Once you get into EQSIS website here, you have research tool. Underneath, you see at the money premium analysis. So once you get into at the money premium analyzer, so here is the tool, and this tool helps us to perform at the money premium analysis. As I already told you that this is a part of option chain analysis, but specific to at the money premium analysis. I mean, we have a very few filters at this moment, which helps us to crunch these data specific to a premium belongs to the at the money strike prices. Going forward, if we find any more logics which can support this at the money premium, which we can even include it here. So you can expect update on this particular tool. But if you have anything to contribute, you can contribute it by participating in the below comment section. Coming back to this particular tool, at this moment, it gives you option to filter based on the underlying, that if you want to pick only the Nifty, then you get to know by typing Nifty, you have Bank Nifty, Fin Nifty, Mid Nifty, Nifty. So in one few clicks, you get to know the underlyings and you get a lot of details specific to this, and you have a section to expand it here as well. So I'll be talking about that area in later. And here you get a quick clarity that until when this particular data gets updated. I mean, this gets updated as on 13th June, which is until Friday, this particular data gets updated. And here is the straddle range. Okay, now we have a couple of a filter. One is high straddle range and low straddle range, that I'll be explaining it using whiteboard again, and I'll be talking about indicative volatility here. Okay, so what do I mean by high straddle range? Let me explain it using whiteboard here. So if you look at the high straddle range, that if a stock is here, okay, if a stock is here and this is 100 rupees a stock, and we have another 100 rupees stock. So this is a company A and this is a company B. So when it comes to straddle, we buy a call option and we buy a put option. Okay, so to buy a call option and put option, we collectively end up paying a premium that adds cost to our strategy, and we expect that particular thing to break even by moving either up or by down. So this is the range that we call it as the straddle range. Okay, so we have a company A, we have a company B, and this gives about a 5% range, or this gives about a 7% range, let's say. So we want to know which particular underlying is giving us a wide range. Okay, is it the company A gives us a wide range, or is it the company B gives us a wide range? In this particular scenario, both the companies got about the same days to expiration, which is about, let's say, 13 days to expire. So when we have a 13 days to expire, considering both the companies, this particular company got a wide range here. Am I right? So how this is done? By taking what is the total at the money premium we have divided by the underlying or the at the money strike price, anything you take, because both are very much nearby. So you end up getting that particular percentage that gets compared across other companies. So when you have A, B, C, D, and we need to rank it based on which particular company got high premium range when compared to the companies which got low premium range. So in a similar way, if you look into this particular table, we have high straddle range. It means these companies got a lot of at the money for their strike price. So big movement is expected. Maybe that is the reason why that the premiums are high. Or another way around, if you are a short straddle guys, then you have quite a good range for you to remain in profit. But that you need to know by double check with the volatility. That I'll come back to it later. Okay. So here you get to know about the low straddle range as well. So if you pick up a low straddle range, you see those premiums are peanuts with respect to their strike prices. They don't even get about a 2% even. So if you look at this particular case, it's about for Axis Bank it's about 3% here, and it is about a kind of 2% here, and it is about 626 rupees, but it is about 26,000, so it's about 2%. And we have, so what we need to do is we need to compare this with at the money AB Capital. Let me show you what is this 11, from where the 11 we got it. So go to NSE website here and go to AB Capital. Okay, so AB Capital, go to AB Capital here. And if you go to AB Capital and you have a lot of data loads it here, and go to derivatives and go to option chain. Okay, go to option chain, allow this to get loaded. Okay, and once you get down to the at the money strike, which is, if you look at the underlying, which is 240.6. So at the money strike is 240, and you have a premium of 6 rupees and 5 rupees, close to 11 rupees we have. So that is what the at the money strike is, 240, and we have a premium of 11 rupees. And not just that, pay attention here. If you scroll down here, if you just open this by clicking this plus mark, it gives you the history. And this is what the power of this particular tool, because if you look at this particular data, it gives you different expiries: 2024 August expiry, 2024 September expiry, October expiry. I mean, of course, we didn't get it from this November expiry, because the November expiry, that the same 13 days may not be there. Okay, we have 12, Jan, Feb. So we have a different expiries. On different expiries, what was the at the money premium specific to 13 days before the 13 days before the expiration. Why 13 days? Because considering today, I mean, considering 13th June, we have 13 more days to expire for this particular contract. So when we have a 13 days gap, that is quite good to compare with other contracts with the same duration. So these are the premiums we had when the contract had 13 days to expire. So this is the 10 rupees premium we had for April month, where it is 13 days before that expiry, and that particular day the underlying the strike price is 185. So we need to consider this, and we need to understand whether this 11 rupees current premium is in line with this, or quite above, or quite less. By any chance, imagine if this is 25 rupees, then by looking at this data we get to know for some reason market is discounting more volatility, more premium when compared to the historical things. Am I right? And look at this particular data. It is also important because this is specific to the current expiry. Remember, this is specific to the current expiry. Current expiry is 26th June 2025, but this is a data belongs to 2nd June, 3rd June, 4th June, 5th June. So how are these premiums are getting reduced? Because sometimes you see this premium due to theta decay, the premium tends to go down. That's natural that the premium goes down. But sometimes it dips faster. Sometimes it doesn't actually get dips. It sustains at one point in time. That gives us a clarity that is this volatility is draining, or is it adding up. So in order to do this analysis, if you are not familiar with data analysis, you can use this particular filter, which I give you a bonus tip at this moment. But how to form strategy using this, probably we will look into it if the requests are more in the comment section in a separate video. But this is specifically about data analysis, so I limit myself by using a couple of filters here. Okay, now let's take a logic of high straddle premium. So if you get a high straddle premium, you end up getting Angel One, BDL, BSE, because these companies are having quite a good range. So if you ask me, in one grounds, the premiums are quite higher than usual premiums. So anything which is higher than the equilibrium is good to create a short position. Okay, because when you have expensive high call and high put premium, and if it is quite expensive and a logic, it is good to create a short position. But on the other way, market is also expecting something more, so you cannot take the market for granted as well. So we need to play around between these two stuff. But in order to decode this particular area, you can look at how are the premiums in the recent time. So if you expand the BSE here, you get to know, look at this particular premium here. When compared to other companies, BSE got, quite a good amount of, a range, because its strike price is 2,700, but we got about 200 rupees premium, which is close to 7-8% when compared to other companies where we got about a 2 or 3%. So we got quite a good range. But compared to in the recent times, look at this, the premiums are actually not as great. Am I right? Okay, now this is not comparable because see, sometime back it was traded at a different price. So you need to make this into a percentage basis. So considering that particular fact, this is again slightly high because this is before split or bonus, and this is after split. So consider this on a percentage basis. So that's how it is. So it is not a low premium here. It is quite a high premium here. And compared to the recent times, look at this one. It was 242, 265, 260, 257, 245, and sudden dip really happened in these 2 days. Can you see there is a sudden dip happened here? Because for a long time it was 240, 232, 232, 232, and only the last 2 days it was able to get 10% off from the premium. So it is, this data helps us a lot. But if you want to know, crunch it based on high volatile range, BSE is still having high volatility expected. Okay, it is having a high range, but market is also expecting high volatility. By any chance, if you want to know the stock which has a low volatility expectation, better click on this combination. It means Manappuram is having a good premium. Manappuram is having a good premium, but it is expected to have a low volatility going forward. Maybe it is good for option sellers. Maybe it is good for option sellers. Okay, what is then good for option buyers? Okay, and then option buyers are expecting a low straddle range having a high volatile scenario. Maybe it is Nifty now. So Nifty is actually giving us a clarity with respect to, the straddle range is relatively low when compared to other underlines, but the volatility is expected to be high because if you look at the why Nifty, we have so much of history because it is all weekly expiry. So every time before, if it is a weekly expiry, it is not 13 days before, maybe about a 5 days before, am I right? So if you get into this, scroll down and look at the history now. Current expiry, we have only two data, am I right? 13th and 12th with respect to, but if you want to know 5 days before expiry, you have so much of data to do analysis. And considering this way, that you get a clarity that which particular underlying that we can go for long straddle or we can go for short straddle, but do double check with option strategy builders and see your break even points, understand what risk is involved and how to protect, if market has unusual behavior. So make sure that you have your stop loss well in place to protect your capital. That matters a lot. And anything specific to regulatory disclaimers, I'll be adding up in towards the end of this particular video. Do follow. And none of these companies have been recommended, rather are used to explain this particular tool. I hope you understand it. But if you have anything to explain, if you have anything to ask, do make your point in the comment section. Hopefully this particular tool helps you a lot in your trading setup. Wishing you all the best. Happy trading life. Thank you.